Hi, everybody. KT here with Atocha Global Analytics. The Fed is kicking it all over the edge.
Atocha Global Analytics. Please like and subscribe.
Yes, they certainly are kicking it all over the edge. Hi, I'm KT here with Atocha Global Analytics. I just wanted to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. And today, we are talking about some policies that shape. Everybody knows that the Federal Reserve bumped the rate up another quarter point yesterday. Not a big deal. But I have a couple stories here about what the Fed has been doing through all these rate raises. And it's interesting that here in the U.S., our media has a certain perspective, whether it's because of access issues or whether it's because of their own internal biases. A lot of times, American media don't cover things quite the same as it might be covered if it was a completely neutral situation. Whereas overseas media oftentimes will give you more of an unvarnished truth about things here in the U.S. than our own media will. So I have two stories here that highlight that today. So first and foremost here, with the Fed's a recent bump of another quarter point, may be the end of the tightening cycle. I imagine actually the end of the tightening cycle will be, or the pivot that everybody's talking about is actually when the wheels fly off, when we hit a black swan event that really craters the economy. But I've got an article here where the title of it is appropriate. It says, "The Fed says don't worry about U.S. banks, but why should anyone believe them?" And I mean, obviously First Republic was taken over at 4 o'clock in the morning earlier this week. And now we've got PacWest in the bullpen warming up. We've got another bank called First Horizon that's based in the southeast U.S. It's warming up. We're talking some really, really dreadful numbers. The stock prices are kind of in free fall for both of those. And so we have these two articles. And I wanted to start with this one written in the U.S. So why should we believe the Fed? It says here, the aftershocks of the collapse of Silicon Valley Bank, while seemingly fading, are still reverberating around the world. Although Federal Reserve officials have taken pains to assure the public that the U.S. banking system is sound, it is unclear why anyone should believe them. After all, Fed Chair Jerome Powell told Congress the same thing just days before SVB's collapse in March. And oddly enough, we had First Republic collapse just a couple of days before the Fed meeting, and again, they're blowing it off as no big thing. Yet, cumulatively, so far in 2023, the bank collapses actually are larger than everything that happened during the Great Financial Crisis. So, just as an aside. But anyway, they continue here. In the week since, it is reported that the vaunted stress test established by the 2010 Dodd-Frank financial reforms did not foresee the drop in value of U.S. government bonds. And that's because these stress tests were created for different conditions than are the reality we have now. They expected something more like the last financial crisis. But whereas right now since we're fighting inflation, interest rates are going up, so none of the stress tests work. Imagine that. Further on down, it says, as the head of the government agency responsible for supervising SVB, Powell bears responsibility for the oversight failures that precipitated its collapse. Unlike the massive mortgage lending fraud that caused the 2008 financial crisis, the extent of which only became clear after years of review and many lawsuits, SVB's lending seems sound, which is true, and that's because this is not a situation where the assets were bad. The assumptions were acceptable and reasonable at the time that these loans were extended or at the time the government bonds were purchased, but everything has changed so dramatically. So continuing to speak about this, several paragraphs down, they said, yet the Fed allowed it to happen. And by neglecting the role of interest rate hikes and triggering financial sector fragility, it undermined the efficacy of its own stress tests. In addition to these supervisory errors, SVB's collapse was preceded by regulatory failures as the Fed under Powell relaxed regulation on banks like SVB, which it considered to be of regional economic significance but not systemically important. Sorry about that. So, clearly the Fed has they were late to the game raising rates because they thought inflation was transitory. Then they tried to play catch up, but they weren't paying attention to what the impact really would be. And I've said this before that honestly, I just did a video about this. Name of an article was essentially that the Fed is a hammer and we are the nail, because the only thing the Fed has in their toolbox is to destroy demand, and we are the demand in the U.S. economy. So further down, they mention here that they misdiagnosed the problem. It says here, worse, the rate increases reflect the Fed's misdiagnosis of the source of inflation, and this is important, which is largely driven by supply side shocks and demand shifts related to the COVID-19 pandemic and the war in Ukraine. And I wanted to take a moment right here to just talk about the supply and demand aspect of this. And I keep saying that the Fed's tools only apply to the demand side, and it's true. So, here we show a standard supply and demand curve. Now, a standard supply and demand curve, this is economics 101 stuff. If anybody, the Fed doesn't understand this, it's because they failed economics 101. So, this is not necessarily what the Fed would be showing, what we would be showing for the Fed's balance sheet or whatever. This is about just supply and demand and how the two interact. Now, if you look at it, the Fed only impacts demand. That's all their tools. So what else is there? I mean, if the problem, as it noted in this article, is the supply side, why aren't there any tools to impact the supply side? Well, there are tons of tools that impact the supply side. And here's the thing. There's a reason why we have a segment here that's called Policy Matters, because policies matter. Okay, so here's where that applies. So here we have a standard supply and demand curve, and you can see that I'm going to rearrange it a little bit so they're really only focused on supply and demand, and in the center is equilibrium. Okay, so the Fed's tools only apply to the demand side. So, here's the Fed's tools, here's or their policies, and only to the demand side. Now, what else is there? Again, the only other entity that can impact the U.S. economy or the global economy on the supply side is the federal government through fiscal policy and through regulation. And one of the big things with the federal government is, of course, taxation. Now, in the environment we are currently in, the high inflationary environment, lowering taxes could cause far more problems than it would solve. It might exacerbate the problem. So tax cut right now would not be beneficial, or at least it would be very problematic. What we need to do is find a way to lower expenses, lower the costs for these goods to bring that inflation down. So what lowers costs better than anything else? You guessed it, the cost of oil, the cost of energy. Everything we buy requires oil to be produced. It requires energy to be produced. And since oil is still the foundational form of energy in the U.S. and around the world, we need cheaper oil in order to get out of this. Now, Saudi Arabia has been working against us in that they keep cutting their output, causing the price of oil to stay high. And so we're paying between $3.50 and $4 a gallon for gas in most areas of the country right now. It's $3.67 down the street from my house right now. And so we have these kind of prices. If we could cut oil and cut the price of, for example, gasoline, rather than broadly based all derivatives, but if we cut the price of gasoline by $1, it would obviously be stimulative to the economy. It would mean that a lot of people are paying a lot less for inputs, and it would effectively cut costs and therefore put less inflationary pressures on the full gamut of all products and services. However, our federal government won't do that. I'll save that for another time. All right, so picking up from where they talked about the war in Ukraine being a factor, of course, that's much more impactful for Europe than us, but it is, in the instance of oil, of course, that's a global market. But it says, moreover, short of causing a sharp economic downturn, rising interest rates might actually make inflation worse. Okay, a major contributor to increases in consumer price index is rising rental rates stemming from housing shortages, which higher interest rates exacerbate. That is a massive oversimplification, but we'll just go with it. Meanwhile, the Fed's disinflationary strategy could cause youth unemployment among African Americans to jump over 20%. Of course, it's going to have a dramatic negative impact. Of course it will. All right, so 2 quick paragraphs on this. So as matters stand, the Fed and its chair have lost credibility on every front. The current crisis has exposed the Fed's failure to address the governance issues that contributed to the 2008 crisis. The fact that SVB CEO Greg Becker sat on the board of the regional Fed that was supposed to supervise his bank, his own bank, is a case in point. So again, this is about crony capitalism and power brokering, it sounds like, is being referenced in here. Now, the last paragraph says, it remains to be seen whether the still simmering financial turmoil triggered by SVB's collapse will boil over into a deeper crisis. Now, this was published since First Republic, but I think it was written prior. And of course, we have First Republic, and I mentioned PacWest, I mentioned First Horizon. So this isn't done by a long shot. So again, let's he's wondering if it's an impact. This gentleman, the author, is a Nobel Prize laureate, and he's from Columbia University. So you'd think he might know something about what he's talking about. Here's the real scope of it from an overseas paper. Here's the somewhat inflammatory title. It says here, half of America's banks are potentially insolvent. This is how a credit crunch begins. Okay, so half of the banks being insolvent. And so if you have commercial mortgages that are out there and the property values on those mortgages have dropped, plus because of the shifts in interest rate, they are those mortgages are less valuable. And you've got government bonds because of the sharp increase in rates. Remember, with bonds, there's an inverse relationship. Rates go up, values go down. What you've got are these banks have these assets that aren't worth what they once were. To be considered solvent, of course, they have to have assets that are worth more than their liabilities. Well, in this case, a lot of these assets are worth less than their liabilities, and half the bank's assets, if they were marked to the current value, actual value, would be less than liabilities, or they'd be technically insolvent. However, because of our accounting rules here, they are able to keep them on the books as unrealized liabilities. So these assets are at their former value. They aren't yet marked to market. And until there is some event for each of those particular instruments to be revalued, they can remain unrealized losses. So they are able to mitigate or manage how these assets are resolved. So again, even though this headline might be technically correct, it's not fully accurate. Okay, so it says here, the twin crashes in U.S. commercial real estate and the U.S. bond market have collided with $9 trillion in uninsured deposits in the American banking system. Such deposits can vanish in an afternoon in the cyber age. The second and third biggest bank failures in U.S. history have followed in quick succession. The U.S. Treasury and Federal Reserve would like us to believe that they are idiosyncratic, that is, a dangerous evasion. Almost half of America's 4,800 banks are already burning through their capital buffers. They may not have to mark all losses to market under U.S. accounting rules, but that does not make them solvent. Somebody will take those losses. Again, I've already explained that. It's spooky. Thousands of banks are underwater. A banking expert from Stanford University named Professor Amit Saru happened to comment, let's not pretend that this is just about Silicon Valley Bank and First Republic. A lot of the U.S. banking system is potentially insolvent. So again, foreign reporting is actually disclosing what's really gone. They go on to highlight the full shock of monetary tightening by the Fed has yet to hit. A great edifice of debt faces a refinancing cliff edge over the next 6 quarters. I love the writing here, by the way. Only then will we learn whether the U.S. financial system can safely deflate the excess leverage induced by extreme monetary stimulus during the pandemic. And before we continue, please hit the subscribe button, hit the like button, hit that bell so that you can be notified. It really helps us out. Thank you much. Okay, so continuing here, it says a Hoover Institution report by Professor Suru and a group of banking experts calculates that more than 2,315 U.S. banks are currently sitting on assets worth less than their liabilities, so they're technically insolvent. Okay. The market value of their loan portfolios is $2 trillion lower than the stated book value. So that's a pretty significant amount. So these lenders include big beasts. One of the 10 most vulnerable banks is a globally systemic entity with assets over $1 trillion. 3 others are large banks. It's not just a problem for banks under $250 billion that didn't have to pass a stress test, which we just read. The stress tests weren't any good. All right, I wanted to highlight something else because we were talking about this slowdown in the economy that is continuing to expose itself. It says here rates have gone up 400 to 500 basis points in a year, and financing markets have almost completely shut down. We estimate there's $4 to $5 trillion of debt in commercial property sectors, of which about $1 trillion is maturing in the next 12 to 18 months. So we are seeing this continue to build, consider it building pressure, and at some point it will release that pressure and hopefully not do tremendous damage. Something more I wanted to highlight. Rates have gone up 400 to 500 basis points in a year, and financing markets have almost completely shut down. That is a big statement right there, because if those markets have completely shut down, that means that there's no financing moving through the system. The financing is the grease in the wheels that keeps the economy moving. Okay, as they continue here, a couple paragraphs down, they said, in a worst case scenario, it could create a doom loop which accelerates a real estate downturn that then feeds back into the banking system, which is exactly what's actually happening. They're just saying when they say doom loop that that's the most extreme version of it, but it is actually happening. It just hasn't gotten to that epic level yet. So what they say here is, in a worst case scenario, it could create a doom loop which accelerates a real estate downturn that then feeds back into the banking system, and technically that's already happening. Some of these debt securities have lost 20% on long maturities, a theoretical paper loss only until you have to sell them to cover the deposit flight. So again, this is unrealized liabilities. All right, just to read the last couple of paragraphs. He says here, the Fed has no intention of backing off. It plans to raise rates further. It continues to shrink U.S. money supply at a record pace with $95 billion in quantitative tightening each month. The horrible truth is that the world's superpower central bank has made such a mess of affairs that it has to pick between 2 poisons. Either it capitulates on inflation, or it lets a banking crisis reach systemic proportions. It has chosen the banking crisis. Of course, the vibe of that particular story really made it hyperbole, but the reality is it is making a choice. The Fed is making a choice, and the choice it has made is it's going to continue fighting inflation with the limited tools it has that are most destructive to the consumer and the individual and the small and medium-sized businesses. So we're in a situation where the Fed only knows how to do one thing, and it is doing it to the detriment of everyone. However, if we shift from monetary policy like we've been doing with the Fed to an approach where the federal government was applying fiscal and regulatory policy, we'd reduce those inflationary pressures by reducing costs by being very targeted on the supply side and therefore providing broad-based relief. Okay, so the banking system continues to be impacted by what the Fed's doing, and until they change their policies and reverse course, it is going to just continue to escalate damage. I've provided suggestions for solutions, but who am I? They aren't going to listen to me. And hopefully, if we vote the right way, they will start listening to us. All right, so tomorrow's Forecast Fridays, got some interesting stuff on tap for you. Talk about a freight recession and some of the metrics that are used to be able to forecast what's happening with the economy, what demand actually is. It'll dovetail great into what was covered today. Thank you for tuning in. Catch you next time.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.